Welcome back. In this lecture, we'll cover investment institutions, which include mutual funds, hedge funds, and finance companies. In addition to investment banks, there are investment institutions which usually raise funds to invest in loans and securities. So, investment institutions are involved in raising funds to invest in loans and securities such as mutual fund, hedge fund. Let's look at mutual fund first. Mutual fund is a financial intermediary that raises funds by selling shares to individual savers and then invest these funds in a portfolio of securities like stock, bond, mortgage, and money market securities. So, mutual funds reduce transaction costs of the investors. In the meantime, mutual funds provide risk-sharing benefits to the investors because they can gather information about different investments more accurately than individual investors. Let's look at hedge fund. Hedge fund is a financial firm organized as a partnership. It is usually an organization of wealthy investors who usually prefer to take a risky investment, normally speculative investments. The partnership is a hedge fund usually up to 99 partners or lower, and they are either wealthy individuals or institutional investors like pension fund. Hedge funds are mostly unregulated and they are also free to make risky investments. Modern hedge funds typically make investments that involve speculating rather than hedging. So their names, that means the name of hedge funds is no longer an accurate description of their strategies. And finally, let's look at finance companies. Finance companies are non-bank financial intermediary that raise fund. That means finance companies get fund by selling commercial papers and other securities. Then they use these funds to make small loans to households and other firms. Finance companies also enjoy a lower degree of regulations. So, a lower degree of regulation helps finance companies to tailor loans which match to the needs of borrowers than do the standard loan of a bank. As banks and other financial institutions are more regulated, they usually provide a standard loan, whereas finance companies can provide tailored loans to the individual borrowers. There are three main types of finance companies. These include consumer finance, business finance, and sales finance firms. That's all about this lecture. In our next lecture, we'll cover contractual savings institutions, which include pension funds and insurance companies.